Hi there, Phil Rogers, Lauren Hall here from Loan Market Edge, coming to you with our weekly wrap. What's trending in lending? Snuck outside today for the 20 minutes that it stopped raining, so I thought we'd do something different and shoot from outdoors today and say hello to you guys. So lots happening. Weather's still crappy, but anyway, if that's the worst thing that happens this week, we're doing okay. A little bit of outdoor noise the one time we go to shoot something. It's
a Mustang though.
Supercar Saturday. So I thought we would, well actually firstly a bit of hot, well it's not hot news, but you would have heard about, or hope you heard about the kidnapping at the local Gold Coast school this week. No, it's fine.
I don't.
It's fine. No, it's fine. He woke up.
Oh, okay. Wow, that's actually pretty good. I will give you that.
You woke up, you like that?
I
Can
will
use
give you
that one. Yes, I sort of warmed in. I really had you a bit worried then that this is where you were headed with that.
Like I'm normally all over the news, not you.
Please.
Okay.
So there's another hot tip. This week, Lauren was interviewed and did e-news with Andrew Bell from Railway Service Paradise. 10-12 minutes of the best stuff you will see on TV this week. So jump on to our socials and check out that video and some really relevant topics. I think it was really good. A lot of the questions that you guys spoke through together. Definitely worth jumping on and having a listen to that. Well worth it. And subscribing in general would make sense. Right, the hot topic. You heard it here first last week. Well, you actually probably heard it bloody everywhere, to be honest. But we're going to claim you heard it here first last week from us. It wasn't really a matter of if, it was more of a when. And, you know, the chat we had last week was really based around what does that mean for you? Yeah, and trying to think about that if these rates, or when these rates, that's what I said, when these rates, not if, when these rates start moving slowly, what does that maybe look like for you in the household? You know, for the budget, we've been at 2%, we had been at 4% prior, we've been at 2%, we knew that was coming, so what were we doing with that money? And we talked a lot about the budget tips, I guess. But then we thought we'd expand a little bit more on that on this week, as it has now gone. The first 1.25, and it appears everybody has taken, well, when I say everybody, all of the lenders, banks, institutions have taken advantage of that.
I feel like they knew about it before. It was a matter of minutes
they didn't know before
they announced as soon as the cash rate moved.
But yeah, they obviously, everyone has moved that 0.25. Look, it's still incredible context, so incredibly cheap. Pre-pandemic, 2 years ago, 3.99 was this crazy low, historically low interest rates and very cheap money, and so the context, cool, we've gone for some clients from 2.25 to 2.5, start to think about this as it moves forward. So a couple of main things, you had a little calculator that we were playing around with.
That was really good. A hot question for us now is, do I fix or do I stay variable? And that's a really interesting discussion because the fixed rates have already moved and they started moving late last year. So nifty little calculator tool was great to be able to see actually over the space of say 3 or 4 years if you did fix at a 4.5 or 4.6 or whatever it is, as opposed to maybe sitting on a variable and allowing for a 0.25 increase every quarter, that in a lot of cases you're actually still better off on the variable. So obviously your loan amount, the difference in interest rates and how long you fix for will are sort of your variables in that. But it was actually really interesting to see because there is a lot of uncertainty and
it is very much a discussion point, right? Where we're not here to give financial advice. We're not here to say variable is best for you, fix is best for you. It is very customized, I guess, to your position at the time and the amount of borrowing capacity, your position in the household. You know, if that did move, there's lots of it, but it was just a really interesting
sort of just the opinion out of it.
It's like here's some numbers, here's some facts, and the understanding that most clients are going to need to work through that and understand what that looks and feels like for them in the household. But thinking a rate of variable rate here, fixed rate here, definitely one's got to be better than the other. Well, it's not necessarily the case. So taking the time to understand that is really important. Obviously, that's what we're here to help you do. Often, again, it's not financial advice, big disclaimers, right? It's not financial advice. We're not telling you what the interest rates are going to do, but it's a general discussion. And
that's where the strategy comes in. If we do opt for a lower variable, well, what are we going to do with that extra money that would have been the difference in the repayment with a fixed? Well, we're going to be putting it back into the loan. You know, just things around having a plan and having a strategy and understanding what those numbers look like, rather than making a decision maybe based around the media or emotional, maybe what you think is right. It's just really good to get as much clarity and as much information as you can before you make that call.
And to quote from a recent interview, which was yourself, talking about maybe, you know, what a variable was good for and what a fixed was good for.
Yeah. Oh, you want me to do that?
Yes,
Okay.
quoting you in, right?
Okay, perfect. I was thinking I've talked so much in this, I can't believe it. So variable is obviously your flexibility. If you need flexibility around paying additional off, around selling property, offsets, redraw, that's where having flexibility of a variable is more appropriate. Fixed is your stability. Do you want to sleep at night knowing exactly what those repayments are going to be? Well, then that's where, you know, your fixed is appropriate for you. So it's understanding again what those different rates mean, and the concept, I suppose, behind them, and then again understanding goals, objectives, and then if we do pick one, what is the strategy behind that, and what are we actually trying to achieve?
Working in your best interest, because that's what we do.
Yeah.
So repayments is probably one thing we're going to see change. So you've got to think there was two things we were conscious of, I guess, with rates starting to rise. One is repayments. Yes, you've got to be understanding of that, change that budget. What does that mean for you? And the other one's around borrowing capacity in itself. So right now, whatever the actual interest rate is, the banks will have a buffer or an assessment rate in there of about 3% higher. So as the interest rate starts to rise, so does the assessment rate. So suddenly you're being assessed on a 3% instead of a 2%, which means that your borrowing capacity will somewhat start to reduce under rules with the assessments rate, debt to income ratio. There's a heap of calculations. And look, I agree with the calculations, responsible lending. There's a lot of good stuff in there to make sure that people aren't stretched or overexposed, I guess, to debt levels, knowing that things like this might happen. But what that also means is a pre-approval, as this starts to happen, if this happens once a month for the next 3 quarters, let's say it is 0.25, so in, you know, towards the end of the year, if that's happened, or just in three months' time, suddenly you're being assessed at nearly 1% higher, which means your borrowing capacity is going to reduce. So the pre-approval you potentially had from 3 weeks ago that's valid for 90 days, when you get to the end of that 90 days, if it was tight then, it's potentially going to be in the negative, and you're looking at a lower amount. So really conscious of what that means for people, and making sure that over these next 3 to 6 months, as this has become now probably going to become part of, unfortunately, a little bit of movement across the board, we need to be prepared for that. You need to be prepared, one, in your own budget and your own household, for an increase in those expenses, which we should have set aside previously anyway, because if you were working with us, we would have done that. And 2 is understanding that your borrowing capacity there's going to be some effect on that. And definitely worth reviewing that. Some of the benefits of working with a broker is obviously every bank does lend money differently, and they are going to have different interest rates, and they're going to have different assessment rates. They also have it for variable as well as they have it for fixed, right? So understanding it's not as simple as, but I was on a particular bank. I was on a particular bank calculator online, and they said I could borrow X. Yeah, well, I'm pretty sure that X isn't correct. So reaching out to us, having those conversations early, reviewing and renewing current approvals, but taking the time to go through them with us first, even before applying, is absolutely the preference. So just note that it's coming. Things are changing. It shouldn't be a significant, I was going to use the word violent, but that sounded very angry. There's not going to be too big a shift in what this is, but it's starting to come.
It will gradually
These little increments are going to happen, and they're probably 2 big standouts for us. Think about your budget at home, and also think about your borrowing capacity when you're looking to purchase. And that's probably our hot tips. That's what's trending in lending this week. Bye for now, and we'll see you guys next week.
Cool.
Bye.
Bye.